For those of you who don't know, I'm Greg Malamut. This is my brother Jim. We work together at Greentree Mortgage. We're one of the preferred lenders in the office. I know there's several different mortgage people. It seems like every other week there's a new mortgage company coming in. So to give some background on us, our family's been in the mortgage business for 30 plus years. Our dad, when he was alive, started a mortgage company. That was in 1989. And Jim's been doing this 13, 14 years, maybe longer, 17. He's getting old. I've been doing it 5 years with Greentree. So we're local. Our office is down the street. We're right on Fire Road next to Avalon Flooring and Tile. So, one of the biggest things about us is, besides the fact that, we're, dedicated to getting the job done, getting your buyers to closing on time, all the usual things, is, we are local. A lot of the other lenders, even the preferred lenders in this office, they're not Atlantic County people. They're not born here. They're not raised here. Some of these people are traveling an hour plus to come in the office once a month.
They only would drop their stuff off.
Yeah, like we're local, dedicated to this area. Our office down the street, and definitely have a passion for the community. So that's kind of the initial kickoff of who we are. And now I don't know if you guys have any questions, anything you guys want to talk about specifically. If not, we can kind of go into some of the topics we had planned, but obviously the most important thing is giving you guys what you want to hear. So if you want, we can just kind of go through it all. If you don't have any questions to start.
I imagine you're going into where you see mortgage interest rates going in the future.
Yeah, we made a little agenda for the people in the room. Yeah, so first thing, we can talk about state of interest rates. So as you guys probably have heard, some of the newer agents might not be as following these things, but rates did jump dramatically from the past few years till present day. So for the past 2-3 years, interest rates were in the 2 to 3%. Is historically at the lowest they've ever been. A few months ago, things shot up. Everything was good, going in the world. The economy was booming, house prices rising like crazy, and the government, basically, their Federal Reserve, is like, we need to slow these things down. So in order to slow down spending, what they do is they raise interest rates. And when they raise the interest rates, it has an impact on everyone, as we're all starting to feel now in the market. When the rates go up, buyers can't get approved for as much of a purchase price. So someone who a year ago was pre-approved at $250,000, they're only going to get approved about $200,000 now. And they could have the exact same income, the exact same debt, exact same credit score. And the reason for that is the higher interest rates.
Yeah, that's right on the money. So, it's starting, I think the last 2 months, we're starting to see a little bit of a slowdown overall. I would say we're picking back up recently in the last maybe week or two. Our August closings look pretty good. September looks decent, but July was definitely slow for us. June was a slow month, which led to July closings being slow. And I do think there was like this temporary, not pushback, but holding period for buyers in June, where people were a little concerned about where things were going on interest rates, and no one wants to buy at the peak of the market. So I think people were like, "Oh, my housing market about to crash. What am I doing?" So I think you kind of saw that in June, and now interest rates have actually gone down in the last 60 days, almost 1%. So we're down now to about 5.2, 5.1, 5.3. Just depends on the day, I would say. We're in the lower fives now compared to the lower sixes in the beginning. So I think things are starting to stabilize there. You've also seen oil prices stabilize a little bit. Oil prices come down from like $5 to the lower $4. So I think that's giving people a little bit more confidence overall too, that the world's not ending, and that oil prices aren't going to keep going up forever, and interest rates aren't going to keep going up forever. So I do think there's things that are some positive factors in the last 30, 60 days that you're starting to see a little bit more activity than you were. But there definitely was a little bit of a slowdown due to these higher interest rates. And Thankfully, they've come back down a little bit and it's starting to speed back up. So, prices, I hear they've come down, but from what I'm seeing, they're not down much. If you price a house right, it's pretty, gonna sell. It's just if you're over, it's not selling. So I think the market's kind of corrected itself, and to me, my word of the day is normalizing. Okay, I think things are just normalizing in the markets. Interest rates are kind of normalizing back to the fives. The values are kind of normalizing again, and it's still a seller's market because supply is not normalized. Okay, that's the biggest issue. Supply is not normalized.
Exactly. I agree with all that. There was a period where, if a house hit the market, I was sending a pre-approval, I didn't think the buyer was gonna get the property. I just knew there was gonna be 10 other offers on there, people with crazy contingencies or lack thereof, no contingencies, no inspection, and like that. And it's getting back to like the normal period, like Jim said, where if you're submitting a pre-approval, there's a decent chance that we're gonna get the offer accepted, I would say, maybe with some negotiation. We're getting someone admitted. Okay, I think that worked. Joanne, welcome. So that's kind of the overall state. Obviously no one has a crystal ball. If we knew where rates were going to be going exactly, we wouldn't be doing this job. We'd be trading futures. But my opinion is I think things are going to stay around the same. I think probably high fours is where things will settle. For my guess is for the next foreseeable future. Obviously, it's not going to stay the same forever. And my typical advice, people say, is it a good time to buy? It's not a good time. Obviously, we're incentivized, saying it's a good time to buy. But let's say in terms of just interest rates alone. Right now, if we say rates are at 5%, is that a good time to buy? Yes. Because if rates go to 10%, you got a good deal. You're locked into that 5%. If rates go back down to 4, 3, 2%, you can always refinance. You can always lower your payment. This way, if they keep going up, you're protected. They go down, you refinance, take advantage. Kind of a good selling point.
It's the date, the rate, and marry the house. That's the new line. So marry the house and date the rate. And you can always change the interest rate after closing, come down later. Personally, again, I don't think values are coming down. I think we're still on the upswing. It's just we're in a much slower growth period going forward than we were the last 3 years. I would expect single-digit growth next year versus the double-digit growth. And I think that's healthy, and again, that's normalizing. That's my word of the day, normalizing. That's I'd say the state of the market that we can see. I'm sure you guys kind of see similar type things. Any questions or thoughts, feel free to add. And Maria.
Between 4% and 5%, is that about a 20% difference in purchase power?
It depends on your loan amount, but yeah,
It's about 20%.
it's about 20% difference. Yeah, significant.
Yeah. Exactly.
As I know, from we've gone up 2%, let's say, since January. It's about 50,000 on the loan that you bought. So it's about 20%, but it depends on how much you're borrowing.
Yeah.
Yep.
And one of the things too is like the interest rates, obviously it affects how much you can afford to buy. But your typical client who is moving for a new primary residence, they're gonna buy or sell regardless of the rate. These people have a true need. It's impacted more, I would say, investors, maybe it's the second home people, because now you're paying 6% interest for an investment property. It might not be as attractive as different investment opportunities. So that's something to consider, but
At the end of the day, it's still better than renting, and rent prices are crazy. There's I think there's less supply of rent than house to own. So it's still, better to own than rent. I think, if you compare the same house, what the cost is to buy versus rent, for the last 2 years was so much cheaper to own it. Now it's comparable again, but still you get tax deductions like that. And you get the equity, or you get nothing. So those are the key points for as a realtor that I'd still throw out there, is that it's still better to own than rent.
so that's kind of overview of rates, mortgage market, things like that. Some other things we want to talk about, which are just best practices, helpful things you guys should know as realtors that we see as whether it be pain points or just good things for you to know. So well and septic. When I first started doing mortgages, I didn't even know what a septic was. I had no idea. It had no idea how impactful it was going to be to the next, part of my career. It seems like there's constantly issues, and we run into it well and septic on out. So something you guys should know is, ask yourself this question: do you think we require well and septic certs for every property? Some people are saying yes, some people are saying no. The answer is no.
Yes, no?
The answer is no.
We don't as the mortgage.
Yes, exactly. In order for us to get a loan approved, the majority of the time, we do not require a passing well and septic cert. Now, do you still want one for your buyers? I would say you most likely, unless they're crazy and don't want to get into that. But for us to get a deal approved, we only require a passing well and septic cert if the agreement of sale specifically says passing well and septic cert, or if the appraiser notes there could be an issue with it and to get it inspected.
Or to VA or USDA loan. VA and USDA it's required. But I'd say majority of loans are FHA conventional. Okay, so the majority of the time you're not needing well and septic cert. Okay, and a lot of realtors think we do on FHA, but we don't. Okay, but we will if it's specified in the contract saying the seller will provide a cert. Like the end of line 13. I get line 13. I was taught people write in the addendum and say things like, "Oh, the buyers are going to get a well cert, or going to get a structural cert." Anytime anything gets written in, we're going to need it. So I always say, do a separate addendum, and then I can hide it better. Okay, but when it's written in on the contract, sometimes my whiteout doesn't work as well. So we're here again to help you guys get to closing. I don't want to act like I'm doing anything wrong. I want to get you guys to closing and make sure everybody's on the same page and that everybody's happy. But we don't want to do anything that's going to upset your buyers or anything like fraudulent. But if you guys want to close without these things, don't put it on the contract. That's my best advice for you.
And some townships require for a CO,
Right.
So things like that. So we're saying it's not a lender requirement. Whether or not you still should do it, most likely, but a lot of times, we get pressed that we need to close on this house ASAP. And then, during the process, let's say the septic fails and your buyer still wants to close. The seller is willing to make the repairs, but the seller doesn't have the money until they sell the house. So if we had the contract saying septic certs required, and now we can't close because the septic failed, that's when we run into an issue.
So best advice is do a separate addendum for any kind of repairs, anything that's not on your standard contract. Do it on a separate page, and
We don't want to know about it.
we don't want to know about it. It's much easier for us or any other mortgage company to then lose that page from the contract.
So that's well and septic. Another thing we want to talk about is solar. Solar seems to be an issue often as well for multiple reasons. So right away, if you're the listing agent and you're listing a property with solar, get the solar agreement from your seller. That's going to solve a lot of these future issues. If you're a buyer's agent and the house is solar, get a copy of that agreement, because certain times we have to count that solar as a debt. Sometimes we do not have. So most of our buyers, they stretch themselves to the absolute maximum that they can get approved for. That debt to income ratio, most buyers go to the most they can. If you then have to add solar on as a debt, your buyer might not qualify. So it's definitely something to keep in mind. We can also talk about the transfer and the liens and all that.
Just solar's a mess. Just you want to get your buyer involved as soon as possible if there's a solar and transfer. Don't let them sit on it till 2 weeks, 3 weeks, because I've had too many issues where we do FHA loan where let's say a buyer has a 640 credit score, and then the solar company wouldn't approve them for the solar. Okay, so we'll give them the mortgage, but they can't get the solar now in the house. And I've had just too many solar issues over the years where septic solar, I hear those words, I cringe sometimes because I just know it's going to delay my closing or cause us a hardship, get us to the table basically. So the sooner you address solar, the better. And because again, like Greg was saying, these companies put liens on the house. All right, so you have to get the lien removed by the solar company to close. You know, they have more control than any of us at times. So you really have to get the solar company involved as early as possible. We see it would happen too much too late in the process where it delays closing. We don't like that. You have to rate locks, homeowners insurance has to get rebound again. It's just a mess when
And while he mentioned rate locks, it's probably a good thing to talk about that because a lot of people don't understand or know how they really work. So kind of to give a rundown of the entire process. Right when you get under contract, we can technically lock your rate. Before you're under contract, we can't lock you in because we don't know how long it takes to find a home. You know, it could take you a year, 2 years, 6 months, whatever it is. And the rates change daily, so we don't know where the market's going to be at that time.
plus we need the exact term, sales price, how much you're borrowing, the address, like we need those kind of terms. They might change a little bit, but your address isn't changing. You know, like that's part of the rate.
So let's say today's what, August 11th. We're gonna close 9/10. Okay, so that's about 30 days from now. Your buyer could do a 30-day rate lock because we can lock in different increments. Typically, it's like 15, 30, 45, 60. So we want to be as close to that, date as possible. And the reason for that a lot of people don't realize is the further out in the time we're locked, the higher the rate you're going to pay. And the reason for that is we're hedging where the market can go at that time. In a 15-day time period, typically not much can happen. Over a 60-day time period, more can go wrong in the world. There's more volatility. So as a result, if you want to hedge that risk, you typically pay a slightly higher rate. So we try to lock in as close to the actual closing date as possible. We always leave a little bit of wiggle room because we know delays can happen for whatever reason. But yeah, once you're locked in, you're locked in. We usually tell people once you're locked, forget about it. Don't drive yourself crazy checking the rates every day after the fact. But yeah, it's one of those things. If you're comfortable with the rate, I always say just lock it and be done. If you're more of a gambler and because you will get better pricing on a 15-day lock versus a 45-day lock, then we can let it go.
Are they paying for those locks?
No fees or anything.
They're
long lock.
Yeah, there can be a fee if we go past the date. So let's say I've got a deal going on right now with one of the agents on the Zoom call. We were supposed to close a month ago. There are issues with the seller and title. They had to request like a chancery abstract. It's taken another 6 to 8 weeks. Still 8 weeks have gone by, it's still not resolved. And we got the buyer locked at a really good rate, at the time. And unfortunately, there's a cost to keep extending that. So to extend the rate lock, there can be charges. We usually try our best to eat the charge if we can, take it off what we're going to make on a deal. And sometimes it can be costly and out of our control.
Just depends.
Yeah. So that's rate locks. We talked about solar. The next big thing we see all the time is condos. So I know there's some newer agents and more experienced agents. So kind of give like a full rundown of condos.
We talk for condos. We can have a whole class on condos. Always.
Probably the one of the most important things, even to take a step back, is there's different loan programs that we mentioned. USDA, that's for rural housing, no money down. There's VA, that's for veterans. If you're not a veteran, you can't do that program. FHA and convention.
I'll be done in 15 minutes.
Is it? So not muted. All right, whatever. Probably Flamore is not muted. So
That was Al. That wasn't me.
So most condo associations do not allow FHA finance. So if you leave here with one thing, know that. Because a lot of buyers want to buy a condo, and FHA buyers are typically, you're less off financially speaking. They might have worse credit scores, higher debt to income ratios, whatever it may be. So as a result, these people typically can't get approved for as much money. Thus, they want to buy a condo because condos are less expensive. The issue is the condo associations don't like FHA financing for whatever reason, or multiple reasons. So most condo associations want your buyers to be conventional, which means they have better credit scores, better down payments, potentially better debt to income. I'll let Jim talk about what we're looking for when we do our condo questionnaire and what that even is.
So, so again, it's not really the associations. The FHA has a list, and each condo association is basically responsible to get certain documentation to the government in order to stay approved or get approved initially. And I'd say about 99% of condos are not FHA approved as a result, because they just don't have the manpower to keep up with what the government requires. And as a result, they just fall off the list of. So there might be 3 condos in Atlantic County, or 5 condos that are FHA approved right now. So that's the issue. You can't do FHA on them without doing what's called a spot approval. Okay, a spot approval can be done. It's a challenge, but if you have a willing seller who understands what's going on and will take that risk, then FHA can be done, but it's just not as easy. So what happens is you have these conventional loans or VA or USDA, and it's limited for buyers that and they're just more risky. We do a condo questionnaire if it's a conventional loan, and each questionnaire has the same questions on it. How many people live there, or how many people rent? Has the property been transferred to association yet? Or so there's some that are still built that hasn't been transferred. So stuff like that. The biggest issues, litigation. I have one in Oyster Bay right now where somebody got killed and they're suing the association for a murder outside of the in the parking lot, and then there's balcony issues. There's balcony issues in the one in Atlantic City. I'm sure everybody heard about Ocean Club. So that the litigation is a huge one. If there's repairs or maintenance issues, that's a new big one. And we just have to get more information from the association to see if we can get around it. And they're just more challenging, unfortunately. Condos are much more challenging than a single family house. So, and if you put less down on a conventional loan, you get what's called a full questionnaire instead of a limited questionnaire. And the full questionnaire has more questions, and you have to get a copy of the budget. Okay, and the budget can kill your deal too. So if the condo isn't putting 10% of the revenue for what they collect in dues into reserves, then the condo is ineligible because there's not enough money going. Okay, but to kind of get around that, you can put more money down. So I have people buying in the Woodlands right now. Okay, and you can put, let's say, 10% down as a primary, 25% down as an investment property, and those questions don't get asked.
Is this FHA still or?
Convention.
Oh, you can do it with 10% down?
For the primary. So with a primary residence conventional loan, it's a limited questionnaire, it's less questions. And some of these issues that come up on the full questionnaire don't come up on the limited question, especially the budget. That's, I say, one of the biggest ones. I have another one where it's a 6-unit condo and one person owns 4 of the units. Okay, that's not going to work, whether it's a full or limited review. That question is asked on both, but the budget is not required. So it's just different issues are going to kill deals no matter what, versus other issues you can get around.
So condos are complicated.
Yes.
We do plenty of condos. I know we're not trying to discourage that. We do so many. I don't know, maybe
We do plenty.
50% of our deals are condos.
It's just more challenge.
And then it's just getting ahead of these things. A lot of times the building manager kind of knows, hey, have deals been financed here or have they not? There's ones in Atlantic City. Ray. I think you're muted, Ray.
Yeah, hey.
Hey.
With the condos, with conventional, you mentioned down payment percentage. Do certain condos have a certain down payment percentage requirement, or is it just you just can't do FHA, but if someone's qualified for a 3 or 5% down conventional, can they buy any condo with that?
So
Or
it's kind of, so that's kind of where it depends on what kind of review we do. whether it's a limited or a full review. So with the limited review, that's when you're doing more money down. So if you're doing 10% down as a primary, it's a limited review, or 25% down as an investment property, it's a limited review. But if you're doing less, that's when we do the full review, and the full review is more detailed. So like a lot of these issues we run into, like the budget, for example, we can ignore it if we do that limited review. So typically, if you're willing to put more money down, we can get rid of some of these potential issues.
Are there condos where you can do a 3 or 5% down?
Yeah. As long as they have everything in line, like up to Fannie Mae, Freddie Mac standards, like, they don't have too many renters versus owner occupants. They have enough money in the budget.
Notification.
Yeah.
Stuff like
All right.
that.
I got a property. We got to chat later.
Yeah. And if you have a condo questionnaire, we can look at it, in 5 minutes, tell you, hey, this is an issue, or, you're going to be fine. The issue is a lot of the, associations, they charge for the questionnaire. So, we don't want to spend a couple $100 out of pocket ourselves for a potential deal. We don't even know if they're going to accept the offer. So we always wait until the buyer's under contract to get the questionnaire, because, they charge us, we charge the buyer. Now, the good thing with us is, we do a ton of business in this area, that we have a relatively good idea of, whether or not Heathercroft works, Oyster Bay, Sunset Harbor, whatever it is. Just because we see a lot of action, so we might have recent questionnaire. So that's kind of the condo part of that. Other thing on our agenda was home inspections, termite inspections, and what we require as a lender.
No
I think the question.
Yeah,
So we, unless it's VA or USDA loan, we don't require an inspection. Well, once again, should you do a home inspection? Should you do a termite inspection? Absolutely. I would if I were buying. You guys probably would if you were buying. Should you advise your clients to? Most likely. But as a lender, we're not going to ask for a copy of these inspection reports. The only thing we do is we do the appraisal. So what an appraisal is, it's an independent licensed appraiser goes out to a property, and they're going to basically determine what it's worth. So they compare it to other, sales in the area, similar beds, size, quality. They determine the value that way. Now the appraiser can also say if repairs are required. And if the appraiser says repair is required, we have to have that fixed prior to closing in order to give you a loan. So, if the appraiser said, hey, there's, very noticeable termite damage, I've only seen it happen one time in my 5-6 years, then that had to be treated prior to closing. The appraiser said, there's a hole in the wall, the electrical panel is not covered and wires are exposed. These are things that have to get treated prior to closing. So a lot of realtors will contact us, before they're putting offers in, like, hey, like, do you think this one will pass an appraisal? And we give our best, estimate or judgment on that. I'd say we're fairly good at that because we see these appraisals come in and we know what are going to be issues, what won't be issues, but we never know until the appraiser actually goes out there and does their thing.
Yep. So termites required on USDA and DA, but nothing else. Same thing as well in septic.
Yep. So certain government loan programs have more requirements.
Exactly.
Only question is there anything for self?
Nothing different than normal for self-employed. Still got to qualify based on your at least your last year tax return. Our conventional loans, we can get by with 1 year sometimes, but it depends on the software. And if you have a 5-year history of being self-employed, I can get by with 1 year tax. Otherwise, we need 2 years. So FHA requires 2 years. USDA, they all require 2 years.
Those are the good old days.
Yeah, don't have anything crazy like that. We do have some ARM programs now for like people buying second homes. If they want to take a 1% less interest rate, they can get an adjustable rate. We'll do those up to $1 million, but they're just not our bread and butter, or that's not where we focus on. I would say that's more like Roach's market area, but just another thing that's coming back. Like you're, people the higher end, they want adjustable rates because the rates are higher. They get an adjustable rate that pay a little bit lower for 5 years or something. Otherwise, I think things are kind of getting back to normal. To my honest is our state of the market today is that we're kind of getting back to normal here in mortgage housing. I think it's going to be a decent fall. It's just gotta just keep getting exactly keep finding buyers. Hard part.
Yep. And for the newer people, the most important thing you leave with is get your buyers pre-approved before you start showing them houses. I'm sure they say that every training session you guys have with Ron and the leadership team, but make sure you do it because you'd be shocked if you sat in our seats and how many people we talk to that have issues getting approvals and need to do some more. Before you start, spending your weekends away from your family, friends, gas money, whatever it is, make sure you get them pre.
But that was a good question bringing up this off. Wait, so you said at least 1 year with a 5-year history?
Yes.
Okay, and then is there any difference when it comes to credit scores for self-employed? Like, do they expect more of a credit score or?
No, it's like so conventional. You're always going to need like a higher credit score typically than the FHA loans.
Right.
You put that's like 50% down. You can get approved with a 640 credit score convention. So
Gotcha.
your down payment, your debt to income ratios, and credit scores all kind of factor in, and the software is the one that approves. The one thing I like to kind of not bullshit everybody like Greentree, Advisors, Cal, we're all using the same software. Nobody's magic around here. Okay, like they tell me like something can do magic. Nobody's doing magic. Jim Malama, Ali Walters, we're all doing the same thing. We're all using the same software, all using the same rules. So don't try to I'll hear realtors sometimes like, oh, this person, they're not doing anything different than me. So I just want everybody to know that. And that's the honest truth. So
What's the credit score that most lenders look at? Right?
depends which loan program we're doing.
Okay.
We'll go down to a 580 on FHA. But your chances of getting approved are not as high if you're above 620.
Okay.
Like you were saying before, like we can go lower, but typically if we go lower, you have to have a better debt to income ratio, more money in the bank, larger down payment. And a lot of the times, the people with the low credit scores don't have that because if they had all these, all that money, they would have better. Yeah, exactly.
It's all kind of released usually, but
It happens.
we have people where it happens. So
Yeah.
And then one last question when it comes to FHA and the condo association, because the whole townhome versus the
good question.
condo
Yes.
is a big difference, but
Confusing.
it's still running into
So
with FHA specifically.
you can do townhomes with FHA, no problem. Condos, you can't without being on the approved list or doing the spot.
But what
I'd
if
say
that townhome is under the association? Alright,
Again, what is considered legally township, whether it's a condo or a townhome, will determine what you can do. So if it's legally a condo, then it has to be on the approved list or you have to get the spot approved. If it's legally a townhome, you're good to go. Now, a lot of people, I'd say, think homes are townhomes and they're usually condos. Okay, there's not a lot of townhomes in this area. Okay, there are some, like Victoria Crossing or
right.
there are some, it's just not a lot. Most times they're actually condos, but so what Greg and I do typically, if we're not sure, is we look up the tax records and the tax record will tell you if it's a condo. Because each tax record has a lot and a block. And if it's a condo, there's a C with numbers next to it. Okay, it's called a qualifier. So you get it's called a condo qualifier. They'll have a C and usually it's like a unit number, but not always. And that lets you know it's a condo. If you don't see that qualifier when you look up the tax records, and it's a townhouse, 99% of the time. Like one time where it didn't have it there, it was actually. So that's the safe way to know it's a condo.
And you can always ask us, hey, I've got a
Right,
property.
and I can look it up. We can look it up in 10 seconds on our phone. I'm on the tax records all the time.
Okay.
So I get that question a lot. But it's always better to teach somebody how to do it themselves.
Yeah.
So it's all just on the tax record.
Literally, I have 4 clients, FHA approved, all one townhome.
Right.
but
but there's not many townhomes out there. So, it's a service, it's an issue we hear all the time, just. We need to do a better job of getting condos FHA in the next decade. It's just not in my control.
yeah,
So,
Okay.
yeah, like I said, we could have a whole condo hour probably, right? Talk about why they're more risky, and why they're not FHA approved, and why FHA doesn't want to deal with them. It is what it is, we just gotta deal with it.
okay.
Yeah, but, anyone have any questions on the Zoom call? Otherwise, I think we're done.
Hey, there we are, Ray Murphy
Sure
joined
enough.
the room.
I gave a lot.
Unfortunately, the other member of the NJ Dream Team's not on person, but we'll give him a break.
The better looking ones here.
That's always.
Yep, I see Famore trying to get something going.
Yeah, we'll mute it.
I heard that, Jim. How can us agents score some sweet Greentree swag that you guys have
Here,
on
They're in
today?
the room.
Doing a cake now, you were dying some.
We have t-shirts, we have
I'll
bags.
come show you one.
Yeah.
Oh, and I want the collared shirt like
We
you
have
guys
these,
are wearing.
we have collar and we have t-shirts, we have both.
Tell me what to do.
Look at
The
this.
issue is they run a little small. I think a lot of the bigger.
We sell money.
I like that. Did you come up with that, Jim?
Just for you, just for you. Sit here. All right.
And we have a few of those
I like it.
reusable bags too. A lot of those are getting taken, so come quick.
And for anyone who doesn't know Jim and Greg, they are not only great mortgage professionals, but probably the best looking and the best basketball players in the mortgage business at the current time.
Probably is the word you eliminate.
Well, we appreciate everybody being here and thank you.
I did have one
Guys,
question.
so much.
Yeah.
Because you mentioned about the price of oil fluctuating. Is there a direct relationship between that and mortgage rates, or is
Yeah,
that just?
I think right now there's a direct relationship between oil prices and interest rates.
Can you
Not,
elaborate?
not normally, but
Ah.
because oil prices are up so much. That's, everybody sees it. And that's, there's inflation right now, okay, as a result. And when you see it every day and it gets into your mindset, you don't want to spend as much money. Okay? And if prices, they're doing that on purpose, increasing the rates and to kind of counteract what's going on with oil prices.
Mhm.
So now that oil prices have kind of come down a little bit, I think interest rates have kind of followed that because they've seen some slowdown in the economy. Okay, so when the economy slows down, oil prices go down, rates go down. And right now, I think rates are kind of following oil prices. Not always tied like that. I think just because right now they were so high and kind of like having an effect on the economy so much that while they were up so much, rates had to go up to kind of counter it. And now that prices have come down, rates have come down a little. Yeah.
Just in the recent, that's not.
And the reason,
historic.
that's not always like that. I think that's just right now in this year, let's say. I think next year, even in a couple months might be different. Like right now, they seem kind of fine. Yeah.